In these next few video clips, I'll be looking at the treatment of intragroup transactions and balances during the consolidation process. Now, before we start to look at the elimination of intragroup transactions, just to recap the consolidation process. So we start off the consolidation process by doing the acquisition analysis, the purpose of which is basically to see whether there's any goodwill acquired or whether there's a gain on a bargain purchase. Okay, so after we've done the acquisition analysis, we draw up two sets of adjustment entries relating to our at acquisition equity. The first being our business combination valuation reserve entries to adjust the assets of the subsidiary that were acquired by the parent company, to adjust it to the fair value of that specific asset or liability if it isn't stated at fair value in the subsidiary's accounts. The second set of adjustments relate to the elimination of the acquisition equity of the subsidiary. So that's where we eliminate the equity of the subsidiary on the acquisition date against the investment in the subsidiary that's reflected in the parent company's set of accounting records. The reason why we pass these entries are to prevent overstating the group assets by including both the investment in the subsidiary as well as the assets of the subsidiary and the liabilities valued at fair value. Okay, so we've covered this in quite detail on the other video clips thus far. So that brings us to the next stage in the consolidation process, and that is where we consider intragroup transactions and balances. Intragroup transactions are transactions between entities within the group that we're preparing the consolidated financial statements for. So, for example, if the subsidiary sells inventory to the parent company, or the parent company perhaps sells a depreciable asset to the subsidiary. Now, why do we need to adjust for the intragroup balances and transactions? Maybe if we look at this last point first, the aim of our consolidated financial statements is to prepare a set of financial statements reporting on the financial performance and position of the group as a result of its dealings with external parties. So in those results that we're reporting on, we only want to include transactions with external entities outside of the group structure. So therefore, any transactions within the group needs to be eliminated, because from a group perspective, those intergroup transactions has not occurred, and therefore we aim to eliminate those entries in full. Now you'll see when we start looking at the elimination of the intergroup transactions that in most cases there's also a tax effect as a result. Now a tax effect occur when the elimination entry of the profits and losses give rise to temporary differences, and this will be the case where the adjustments that we pass affect the carrying amount of either assets or liabilities. So because we adjust then the value of the carrying amount of either asset or liability, of course it's going to have a deferred tax implication. So when you're busy with eliminating intergroup transactions, always keep in mind that we're aiming to get to a set of results only reflecting our dealings with external entities. So if you struggle to get to draw up the adjustment entry, look at the combined result between adding the subsidiary results to the parent company's results. Then sit back and think, what do we actually want to show in the consolidated financial statements? And then what is the adjustment that is required to change the combined results of the underlying accounting records so that it reflects the results of the group with external parties. And that adjustment that is required will be the consolidation entries that we record on the consolidation working sheet. I'm going to use question 17.3, number C, to illustrate the adjustment for the intergroup transfer of inventory during the current year, where the unrealized profit still sits in the ending inventory. But before we look at the journals, first of all, just think, how will you eliminate the full effect of a transfer of inventory? Now, when inventory is sold in the company that sells the inventory, of course, they're going to report a profit on selling the inventory, and the income statement accounts affected is sales revenue and cost of sales. The cost of the inventory is transferred from the inventory asset account to cost of sales, and the sales revenue account is where the sales figure is recorded. So first of all, we'll have to reverse the profit on the sale of the inventory, and secondly, we need to consider whether there's any tax effect on this transaction. Now, with the sale of inventory, the timing of the transfer of the inventory is quite important. In the information, you have to ascertain whether the inventory was transferred in the current year and therefore still on hand, all or part at year end, in which case there will be unrealized profits sitting in the ending inventory, or whether the inventory perhaps was transferred in the prior year but only sold in the current year, in which case unrealized profit will sit in the opening inventory. As I mentioned in this example, the unrealized profit sits in the ending inventory, and that is the adjustment that we have to make. So if we look at the question C, Clare Limited owns all the share capital of Lauren Limited, so Clare is the parent company, and they manufacture certain items which is then marketed through Lauren Limited. During the current period, Clare has sold for 12,000 items to Lauren Limited at a cost plus 20%, and Lauren Limited has sold 75% of these transferred items at the end of the financial year. So there's another, there's still 25% of the inventory on hand. Okay, so between the two companies, the selling price was $12,000. It's based on a cost. So cost is 100, then the markup is 20%, so the selling price is 120. So the profit is then 20 over 120 times selling price. So the unrealized profit was $2,000 at the stage when the inventory transfer occurred. Now 75% of this profit has now realized, so that's 1,500, because these items were sold to external parties, and 25% or $500 is still sitting as unrealized profit in ending inventory. And let's look what happens in the companies. Claire has recorded sales of $12,000 and Lauren has recorded sales to the external bodies of X amount that hasn't been given to us. So that is the selling. The cost of sales for Claire was the cost of sales for Claire on this transaction is $10,000, and for Lauren it would be 75% of the 12,000, which is the cost to them of the inventory. So that is $9,000. So if we just add it together, that would now be 12,000. Plus the X amount and 19,000 cost of sales. From a group perspective, sales should be X, whatever the sales amount was towards external parties, and the cost of sales should be 75% of the cost of the inventory to the group, 7,500. So our adjusting entry has to move us from this column to this column. So to get it from the added together column of 12,000 plus X to X, we have to reduce our sales with $12,000. To get our cost of sales line item, which if we add the individual accounts together gives us a total of 19,000. To get that to the group figure of $7,500, we need to reduce our cost of sales by $11,500. The last leg to that transaction is then reducing our inventory balance with the unrealized portion of the profit that still sits in our closing inventory. Okay, so that then in effect eliminates the profit on the sale of the inventory and eliminates the unrealized profit sitting in our closing inventory. Because we adjust the carrying amount of our inventory, of course there's going to be a deferred tax implication. We raise a deferred tax asset with the resultant entry to the income tax expense account. It might be worth your while, if you struggle with the adjustment entries to pass, to make a summary of the standard entries that we pass in the different scenarios. So if we are faced with inventory transferred in the current year and the balance is still sitting in closing inventory, your entry will always be your debit sales, credit cost of sales to eliminate the profit that's flowing through from the income statements, and we credit inventory with the portion of the unrealized profit that still sits in ending inventory. As I said, because you adjust the carrying amount of the inventory, of course the deferred tax implications that needs to be taken into consideration. If, however, the unrealized profit sits in opening inventory, and I'm going to have a look at that in detail on the next slide, but that is your standard entry that you'll pass. Adjusting your retained earnings opening balance, crediting cost of sales because the assumption is made that inventory that was on hand at the end of the previous financial year will be realized in the following year. And then just the tax effect on reversing the deferred tax asset.